Hey, welcome back to the weekly review. This week we're going to switch it up. Instead of just flying through headlines, I want to discuss a few headlines and explore what they mean for the market and for us as investors. With that said, on Monday, the markets closed down on the day. The Dow was down 105 points, the S&P was down 9 points, and the Nasdaq was down 34 points. The big story exiting the weekend was NYU professor Scott Galloway's letter to Twitter executive chairman Omid Kordestani. Galloway's letter pushed for Kordestani and the Twitter board to replace Twitter CEO Jack Dorsey, who tweeted last week that he plans to live in Africa anywhere from 3 to 6 months in 2020. In addition to being the Twitter CEO, Jack Dorsey is the CEO of Square, the millennial cash register company. Dorsey was fired by Twitter in 2008, but was brought back in 2015 after the company went public and failed to live up to expectation. The stock opened 2015 at $36.23 per share, and as of this writing, it was trading at $30.21 per share. So Jack hasn't really done much in his return. Square, however, is up 400% since its IPO. I've been a Jack Dorsey defender, and my reasons were I felt Wall Street analysts unfairly put Facebook-like expectations on Twitter without fully grasping how either platform worked. Anyone who actively used or uses both platforms understands that there's a big difference between the two. To expect Twitter to do what Facebook does was and is unfair to Twitter. My second reason is I'm a believer that Twitter will outlast its other social media counterparts. I don't think it'll ever be the most popular platform at any point during its life cycle, but I think it'll be here long after Instagram and Facebook fade. For that reason, I was always okay with the slow growth over a longer period of time. Twitter's messaging, Twitter's broadcasting, Twitter's news, Twitter's entertainment, Twitter's hero worship, it's a villain teardown. There's just a lot going on Twitter that other platforms don't have. With that said, these are the issues that Scott Galloway alluded to in his letter. It's a great platform that's been underperforming the markets with its current leadership. Twitter investors have patiently waited for the stock to make a big move, but there's been nothing. Twitter, like the Dallas Cowboys, needs someone new calling the plays. The Jedi Project. It continued to make the news this week. On Monday, AMZN stated that improper pressure and behind-the-scene attacks harmed its chances of winning the $10 billion Pentagon contract. Jedi, which stands for Joint Enterprise Defense Infrastructure, is a Pentagon cloud computing project. Initially, AMZN, Google, Microsoft, Oracle, and IBM were interested in being the cloud provider. Google dropped out after protests from its employees that the government contract would conflict with its corporate values. On October 25th, the contract was awarded to Microsoft. Since the contract was awarded, Microsoft stock has increased by 8.6%. AMZN stock has been relatively flat. The relationship between Donald Trump and Jeff Bezos has been a frosty one, no love lost on either side. On a few different occasions, President Trump has threatened to look into antitrust violations against Amazon, as well as other tech giants. Also, Jeff Bezos is the owner of the Washington Post, and Donald Trump has not had the best relationship with the press. At times, it does feel like a personal vendetta against Jeff Bezos and Amazon coming from the Oval Office. So yes, Jeff Bezos does have a solid reason to gripe about losing out on $10 billion. Does this change anything in the future? Probably not. Right now, Microsoft investors win, Amazon investors lose, but likely only temporarily. Looking at retail, it was reported that Black Friday online purchases increased by 20% and physical store sales dropped 6.2%, and Amazon Cyber Monday sales topped $9 billion. So losing a $10 billion contract does hurt, but making $9 billion in a day should ease the pain a little bit. On Tuesday, the markets closed down. The Dow was down 27 points, the S&P was down 3 points, and the Nasdaq closed down 5 points. GameStop reported Q3 earnings, and it was disappointing. The company reported an earnings per share miss by 66 cents and a revenue miss by $180 million. One of the issues reported was the sale of new hardware. New hardware sales fell 46%, which was expected as gamers await the next PlayStation and Xbox, and Google Stadia not requiring any major hardware at all. Comp sales fell 23% versus the 13% that was expected. The company reported it's on track to close between 230 and 250 stores globally. The company did report an increase in buy online and pick up in-store transactions, and the company reported an increase in conversion rates as well as average revenue per customer. GameStop stock dropped 15% in after-hours trading on the earnings report. In our weekend article In Focus, we've discussed GameStop in the past. We've maintained for 2 years that the stock is an avoid at all costs. GameStop is what happens when 1, an industry strongly dislikes your business model, and 2, technology can't save you. The days of Xbox 360 and PlayStation 3 were supposed to be great days for the video game creators, Sony and Microsoft as well. Older gamers, people who had grown up playing Nintendo and Super Nintendo, had become working professionals with disposable income, and they were still gaming, but instead of buying new games week in and week out, GameStop provided a used game market. which stopped a nice stream of revenue to game makers. During the rollouts of the PS4 and Xbox One, Microsoft had discussed making games have a signature that would allow a game to only be played on one device. Gamers protested loudly, and the idea was abandoned. But now with better internet, quicker download times than what existed 6 years ago, and most importantly the decreasing cost of hard drive space, this has made digital game downloads more doable than ever. Things that we've seen in gaming over the past few years like DLC, downloadable content, were all done to get the revenue flowing back to the game manufacturers and away from GameStop, and it's worked. With cloud gaming on its way, I don't know where GameStop fits in the gaming future. Netflix made the news during the week. Needham analyst Laura Martin downgraded Netflix stock to underperform. She previously downgraded the stock to a hole several months ago. Martin foresees Netflix losing 4 million subs over the next year as viewers switch to lower price services. Needham recommends a lower price tier for Netflix supported by 6 to 8 minutes of ads per hour. Netflix stock has taken a beating since the announcement of Disney Plus and other streaming services. It'll be interesting to see what the numbers say during the next earnings report. I think we're all quick to jump on exciting and new and quickly dismiss the old. I'm using both services. There are things that I like about both. There's a lot of nostalgia with Disney Plus. There's great content with Netflix. I think there will be a few losers in the streaming wars, but I don't think Netflix will be one of the losers. On Wednesday, the Dow closed up 29 points, the S&P closed up 9 points, and the Nasdaq closed up 37 points. Announcements coming from the Fed gave investors reason to be bullish. The Fed held interest rates as they were between 1.5 and 1.75% and indicated that they'll keep interest rates at current levels through 2020. Another story that caught my eye was a report by USB that McDonald's may use more than one supplier for its plant-based burger option. This really wasn't a surprise for a few reasons. For one, Coca-Cola is the only name brand item recognizable to customers in McDonald's. The beef, chicken, and potatoes come from multiple suppliers and we don't know who. So I expected, whenever McDonald's incorporated the plant-based burger into their menu, that it wasn't going to have the manufacturer's name on it. McDonald's was not likely to advertise the Beyond Meat plant-based burger at McDonald's. The other reason I didn't find this as a surprise was because quietly, Burger Kings around the country sold out of the Impossible Burger during that first rollout. It didn't make the news because the battle of the chicken sandwiches was a hotter story at the time. McDonald's won't allow the same issue to happen to them. Beyond Meat will be one of the few plant-based burger sources from McDonald's, and this likely won't hurt Beyond Meat much over the long term. Lululemon reported earnings on Wednesday also. The company reported an EPS beat by 3 cents and a revenue beat by $18.5 million. Revenue grew 22% year over year. Comparable sales increased by 16% in the quarter, which was much higher than the 5.2% estimated for comp sales. Direct-to-consumer sales increased by 29%. Comparable store sales increased by 10%. Gross margin came in at 55.1% and increased from 54.4% a year ago. As impressive as the numbers were, investors weren't impressed. The stock sold off in after hours and eventually closed down 5%. Some issues concerning investors is the upcoming departure of the company's COO, Stuart Haselden. The company has not named Haselden's replacement yet. Also, the company gave fourth quarter guidance that was at the low end of expectations. The company is expecting Q4 revenue of $1.31 to $1.33 billion and an earnings per share between $2.10 and $2.13. Even after the big drop, the stock is up over 85% in 2019. In 2019, Lululemon has outgained Nike, Adidas, Under Armour, and the S&P. On Thursday, the markets were up big. The Dow was up 220 points, the S&P was up 26 points, and the Nasdaq was up 63 points. The markets were up on tweets from the president that a trade deal is close, and by the end of the day, word was out that President Trump signed off on a Phase 1 trade deal. The deal averted another wave of U.S. tariffs on $160 billion worth of consumer goods, which were going to be introduced on December 15th. The deal includes promises by China to buy more U.S. agricultural goods. The deal is a big win for companies like Apple. The December 15th tariffs would have affected consumer goods like phones and laptops. Facebook also made the news. Facebook dropped on news of a preliminary injunction by the FTC. A potential injunction would focus on the way Facebook allows its apps like Messenger, Instagram, and WhatsApp to integrate with potential rivals. The FTC's concern is that Facebook's policies are anti-competitive and making it difficult for others to compete with similar services. The biggest beneficiary of this news was Snap. Snap jumped 1% on the day. As we roll into the election year, I expect to see more news surrounding Facebook and how it regulates itself. On Friday, the Dow closed up 3 points, the S&P closed up less than a point, and the Nasdaq closed up 17 points. The markets jumped from positive to negative back to positive. While China did express during a press conference they were working on a date to sign the Phase 1 trade deal, which was positive, President Trump tweeted that existing tariffs would remain in place. Overall, the three major markets, the Dow, S&P, and Nasdaq, closed up on the week. In some other news that occurred during the week, Robinhood introduced the option to purchase fractional shares. Canopy growth company named David Klein its new CEO, and notorious short seller Citron Research put a $5 price target on Peloton shares. In crypto news, the 4 digital coins that we track were all down on the week. Bitcoin continued to range. It was trading at $7,242.50 at the time of this recording. Ethereum continued to range, trading at $144.12. Litecoin was trading at $44.20, and Ripple was trading at 21 cents. Crude oil closed the week out at $59.79 per barrel, up slightly from last week's close. A big winner for the week was Principia Biopharma, PRNB, which saw a 33% gain on the week. A big loser for the week was Precision Biosciences, DTIL. The stock saw a big jump on Monday, but then came crashing down. The stock was down 47% on the week. If you're ready to get serious about investing and creating wealth, check out our latest quarterly newsletter, The Civil Report. Serious investment ideas presented in a way that an experienced and new investor can understand. If you're ready to master the markets, check out our newsletter at civilreport.com. Any headlines you want to read more about, the link to the full story is in the description below. Thanks again for checking out the Civil Report's market review. This channel is dedicated to anyone who wants to start investing but doesn't know how or where to start. If you have any questions, ask in the comment section, like and subscribe, and may your next investment be your best investment. See you next week.